Welcome to FinTech TV. For decades, the biggest wealth generating opportunities in private markets have been locked behind a massive financial wall. Now, Fairmint is a pioneer in on chain equity infrastructure, and they just submitted a groundbreaking proposal to the SEC Crypto Task Force to modernize these outdated rules. They are proposing a new system where users, developers, and employees can earn the right to invest in private companies regardless of their bank account balance. Well, joining me live here in New York City at DAS 2026 is Joris Delanoue, who is CEO and co-founder at Fairmint. Great to have you here. Thank you so much for joining me.
Thank you for having us.
Well, you've been at Digital Asset Summit 2025. So what's different this year compared to last?
Last year was a massive change for the industry. Clearly, the message sent to the market was America is open for business in crypto. I have the feeling that this year they just put another coin in the machine and they want people to move even faster on chain.
Yeah, I think that's a great analogy for what we're seeing. So tell us what you do at Fairmint and for viewers who might not be familiar.
Yeah, so at Fairmint, we bring equity on chain. We want to make sure that this equity will move on chain in a way that will be frictionless and with a delightful experience for the customers. And the funny thing is, we started by the private market, which is most of the time not the natural path. A lot of the time you see people trying to tokenize the public stocks because it's much easier. When cap tables are public, everything is much easier to manage. You have just one type of class of shares. But the moment that you work on the private markets, then you have a lot more complexity. The cap tables might have like multiple type of class of shares, multiple investors, different waterfall and preference when it comes to liquidation. And so for that reason, I think private markets were still at the Stone Age when the public market were pushed to move on chain. And you mentioned DAS 2025.
Yes.
What was very important last year was the message sent to the public markets, because all the participants over the last 12 months, they coordinated effort to unlock the on-chain capabilities. And when you talk to NASDAQ, New York Stock Exchange, the TCC, like all the big players, you will hear them talking interoperability or automation of the compliance and the transfer rule, all the programmatic things that the blockchain can offer. What's really pity is when you see that happening on the public market, you don't really see that on the private side. And this private side grew so much bigger over the last years. Like in 2025, for the first time, we had the secondaries for those private companies almost at the same level as IPO or M&A. So that's a whole new way of exiting using secondaries SPV. But under the hood, when things are tracked through very robust and clear systems in the public markets, on the private one, still tracking ownership on spreadsheets. You still do manual transfer with lawyers. That's what we are fixing at Fairmint by literally making this cap table move on chain.
And I think you highlighted a lot of points that we have seen evolve in 2026 compared to 2025. So I do want to get your take on evolving markets and also the infrastructure gaps that you're seeing right now.
Yeah, well, I think that there is a blurring lines between those private and public market. And this infrastructure gap needs to be fixed, because when you start to be raising hundreds of billions of dollars, when your company valuation start to be close to trillions, I mean, you technically and legally expect people like this to start getting disclosures, starting making sure that we know what's going on. They have tons of cash flow. We are not talking of early stage companies anymore in the private market. We are talking about SpaceX trying to IPO at 1.5 trillion. And I think if we want to have like a robust market in the US, we need to make sure that we come with a solution there. We need to make sure that those companies, without falling into the whole disclosure system that you have on the public side, we should offer to the people that own a stake in those businesses some form of disclosures.
Well, Joris, it was great talking to you here at DAS 2026. I appreciate your time as well as all of your insights.
Thank you so much.
Thank you.
See you.
Let's do it. Welcome to the show. Let's rock and roll on this Monday. What is the date? March 30th. You're watching Taking Stock. Looks a little different down here. We are on the set for FinTech TV. I'm JD Durkin. Thanks for watching. Major market indexes in negative territory to kick off this holiday shortened trading week here on Wall Street. The S&P down about 0.4. The Dow 30 in positive territory. Goldman Sachs, the strong outperformer. The Dow will finish up fractionally. The New York Stock Exchange Composite Index is down 0.25%, and the small caps down 1.5. Let's kick things off with our good friend, Hardika Singh. She's an economic strategist at Fundstrat. Thank you for being here. Nice to see you. Okay, so you and I were just talking about gold. Is the so-called safe haven trade broken down? Are we viewing gold's performance differently in light of the conflict in Iran?
It's complicated. Gold has and always will have the reputation of being a haven asset, but what that haven means depends on the time frame you're looking at. If we go back to historical data, this type of performance where gold has actually declined during a wartime, it's pretty common. Since 1979, there's been at least 13 instances of geopolitical turmoil, sell-offs, and gold has only rallied through the course of 1 week, 1 month, 3 months, 6 months, and 12 months later. So through that time span, only 3 times. And that was during the global financial crisis in 2008. Then we had COVID-19 crash in 2020, and then also the Israel-Hamas war in 2023. So it was only across those time periods that gold was up. I think what it takes for gold to maintain its status as a haven asset in this scenario is that investors have to believe that this geopolitical turmoil is here to stay. And with the president sort of coming in saying, hey, we're potentially looking at an exit plan, that puts that into question. And I think that's the big reason for gold's sell-off recently.
Is the status of gold and silver as safe havens further called into question because of how remarkable they were as outperformers before the conflict? These were basically just trading in a parabolic way, and it brought this up, and then somewhat range-bound since the start of the year, and then we've got the conflict in Iran. But they were already at such elevated levels. What does that do for the conversation?
The rally last year was just mind-boggling to put into words. It was crazy. Gold went to $5,000 a troy ounce. It was parabolic, like you said. But then at the end of the day, when we do have a conflict like this, just about everything in the market is getting thrown into the red. So investors will naturally take some profit out of gold that they've made over the past year and a half, and silver also, and put that towards, you know, the other assets that are declining in value, just to stop them from falling down even more. It could be that there's a short squeeze going on. If you look at the flows data into GLD, which is SPDR Gold Shares Fund, the biggest physically large back gold ETF, you can see investors are pulling some of the biggest amounts that they have in history. That was during the week ending on March 6th. So I think people are taking the gains they've made in gold and putting it elsewhere to work right now.
Let's talk about the broader market here. Obviously, I was on the West Coast last week, but I was still doing my best to catch up. But we basically have the Dow, you got the small caps, the NASDAQ, all at or near correction territory, defined by a 10% pullback off their recent highs. The big storyline for Liberation Day last year, at least one of the narratives, was retail investors held firm. They bought that dip when maybe institutional dollars got a bit more frightened on the sidelines. Who is buying the dip, if anyone, right now? Is it a lot of wait and see on the retail versus the institutional side?
I think it's the smart retail investors, and I know that sounds kind of ironical considering, you know, their reputation is dumb money. But I really think they've been so smart in the past year, where they have come in systematically and bought the dips. And this year too, I think that's one of the biggest reasons why we haven't seen the S&P 500 and some of the major indexes fall down as much as they could have. I mean, at the end of the day, the effective closure of the Strait of Hormuz, this is an Armageddon scenario. This is a black swan event of sorts, right? We had never foreseen oil prices going up this much. I think it's somewhat, nothing short of a miracle, I would say, that the indexes haven't fallen down more. But yeah, it is still kind of concerning that some of these major indexes have entered correction territory, the NASDAQ especially. How I look at that is basically tech stocks have fallen down enough now to the point where their valuations look super attractive. In fact, the premium that they had built over the past 10 years has been completely wiped out. So for me, and how our team is looking at this, this basically means that the entire AI revolution never happened. And that makes no sense, right?
From a PE ratio, pardon me if I
Exactly.
interrupt, from a PE perspective.
Yes, price to earnings next 12 months. It makes no sense. Why would that happen? You know, AI is still one of the biggest drivers and is expected to be the biggest drivers of the economy going forward. So for me, I think there's only a matter of time before investors start rotating back into tech stocks. And maybe this calms down some of the sell-off that we've seen, because you know the index today, a lot of the sectors were rallying, but tech and energy were down, and I think that was weighing heavy on the index.
Hartika, through the lens of the broader markets, what will you be looking for to give you some sense on long-running sort of interpretations of the conflict in Iran? We've heard the White House repeatedly say it'll be 4 to 6 weeks. We're already on week 5. There's no end in sight. There's plenty of miscommunication and wires that are getting crossed. But what through the lens of the markets will you be paying attention to? Is it something on the Treasury side? Is it some of these previously very high valuations that have come down a bit?
Yeah, I would say there's 2 things that we're already starting to notice. Number one is memory stocks. You know, they were the top performers last year. And this year, Micron, for example, has entered into bear market territory. That's crazy. In just a couple of weeks this happened. Makes no sense, right? So I think that's one of the signs that, you know, investors are starting to rotate out of these high-flying names. And the second thing I'd be looking at is sentiment. We're still seeing bulls hang out in the market. They haven't completely given up. They haven't thrown the towel yet. I think we still need to see sentiment deteriorate furthermore from here, because like I said, this is one of those black swan events. The third thing I would say is that as hard as it may be, I think the best thing to do for investors right now is to do nothing. Because if the president is coming in saying, hey, we're looking for an exit strategy, you need to believe the White House on that. Don't fight the White House, because you're gonna lose money doing that this year. And last year too, to some extent.
Absolutely. All right, Hartika Singh, good friend of ours here on the show, economic strategist at Fundstrat. Thanks for being here. Nice to have you to kick off the week.
Thank you.
Don't go anywhere. A lot more Taking Stock coming up live from the trading floor of the New York Stock Exchange right after this. Let's do it. Welcome back to the show. You're watching Taking Stock live from the trading floor of the New York Stock Exchange. Michael Tannenbaum joins us now. He is the CEO of Figure. Very grateful for your time. Thanks for joining us.
Thank you for Having me.
An online platform, a blockchain-based fintech company. Talk about what life has been like for you and the company since going public in the fall.
We are one of the best performing companies that IPO'd in 2025. So it's been quite a ride, but really exciting. I think the reason why you see that strong performance is we're one of the few companies that's doing something very meaningful in the blockchain space. We are building the future of capital markets on blockchain rails, and specifically, we started in the mortgage space where we built a marketplace of around 300 partners that use our technology to originate mortgage assets into a blockchain-based capital market. And in doing so, they save about $12,000 is the industry average of origination costs, and they can do it in about 1,000, so they save 11. And they can do this process in about 5 days versus industry average of 45. So it's a much faster and efficient process, but our ambitions are actually much broader than just mortgage. So we're expanding into new asset classes. We recently brought on auto loans with a partner named Agora. And I think in general, it shows that we're executing into this really big market of consumer lending and beyond that. And at the same time, we're rapidly growing. So we have about 100% year-over-year growth and about 50% margin. So we're rule of 150 when everybody sort of talks about the rule of 140. So
yeah. What does a future of capital markets on the blockchain look like? And then I'll ask you specifically about the Agora side in just a moment.
The future of capital markets on blockchain is significantly more efficient and significantly more liquid. So I talked about some of the origination side benefits, like the lower cost and the faster speed, but another benefit that comes is the reduction in third-party diligence costs. So as loans move throughout the capital market, they're often verified and re-verified, and third-party diligence firms are paid to do diligence. But what we do instead is we take the attributes of the loan up front, put those immutably on the blockchain, and so any loan buyer doesn't have to recheck those every time. That saves about 80% of third-party diligence costs. So that's one great example. I think another great example is the reduction in fraud. And you've probably seen over the past year or so some really meaningful examples of fraud in the capital markets and double pledging assets. There was a Tricolor bankruptcy, First Brands, MFS over in England. These are all examples where people were double pledging assets to multiple banks. But if you do that on blockchain, you actually cannot do that because you create a digital padlock on the loan, and there's only one verified owner of that asset and of that lien.
You mentioned Agora for auto loans. Is it data that's being shared specifically, or a bit more than that?
It's a bit more than that. It's actually the loan. So what Agora does is they are ultimately a lender to multiple auto dealerships. And they've taken that aggregated loan production that they do and brought it to Figure's Democratized Prime marketplace. Democratized Prime is a DeFi, or decentralized finance, essentially commercial paper market. So short-term, hourly liquidity place that you can borrow against and lend to loans, and Agora has taken their auto loans and brought them onto our marketplace as a way to scale their capital markets and help themselves grow beyond the capital market infrastructure that they have in-house. And because we have so many investors and capital partners that are used to buying our loans on blockchain, Agora can then use our technology, and in a really capital light way for us, we can offer them this broad marketplace and help expand their business while expanding ours. So everybody sort of wins.
So I imagine as you're expanding yours, you're trying to figure out the new rules of the road. Regulations have to shift with that. What does this new age CFTC look like? I'd imagine, or are there other acronyms of choice here that sort of need to evolve with the times? And do you feel as if they are in lockstep with your ambitions, or is it a lot of, hey, we want to do this, we just are still waiting for the regulators to play a little bit of catch up?
Well, Figure has been operating under a number of different regulatory environments. We have state lending licenses, we have money transmission licenses, we have US alternative trading system licenses, as well as global crypto trading licenses. So we have been operating in a number of different regulatory frameworks, and we're not reliant on any one bill to pass to really unlock what we do. As an example, we have a stable coin called Yields, YLDS. And it is actually not a Genius Act stablecoin. Instead, it operates almost like a tokenized money market fund. It's a registered security, it's a face amount certificate, but it's still peer-to-peer transferable. And I think that's a great example of how Figure has historically worked within the existing regulatory framework, but used blockchain to push the capital markets forward.
Congratulations on all the success since going public back in September. Thanks for visiting us down here, both at the Stock Exchange and for being on the show. It's nice to have you.
Yeah, thanks for having me.
Michael Tannenbaum, CEO of Figure. Don't go anywhere. A lot more Taking Stock coming up live from the New York Stock Exchange coming up right after this. Welcome back to the show. You're watching Taking Stock. Leroy Ball joins us now down here on the trading floor of the NYSE. He is the CEO of Koppers, here to celebrate 2 decades as a publicly traded company, just riding the closing bell. Really nice to have you.
Thank you. Thanks for having me.
You specialize in treated wood products. We'll talk a bit more about the business, but overall, what does it mean for you and the firm to be down here, a part of the New York Stock Exchange community here for 20 years?
Yeah, it's exciting. I mean, we're celebrating our 20-year anniversary, and so it's hard to believe. I was here 10 years ago for our 10-year anniversary, the bell ringing at that point in time, and just all that we've seen and dealt with over the last 10 years, especially the last 6, the challenges we've been able to work our way through. And here we find ourselves in the strongest position we've been in, with a more focused portfolio, a stronger and more disciplined operating framework, and essentially we're excited to kick off our 2028 strategy, and got the team down here really energized around that.
What should people know about the broader treated wood product space, especially through the lens of environmental products and considerations in recent years?
Yeah, so I mean, look, it's a space where we make stuff that kills things. That's what we do, right? It prevents fungal decay and protects against insects. So, railroad cross ties, utility poles, basically outdoor structures, whether it be decking, fencing, all those sorts of things, spanning residential through industrial. We do that, and it is a challenge, but we've been doing it for decades on end, and we have a great environmental services team that really supports the team.
Is it somewhat proprietary wood preservation technology? And talk to us a little bit about the key differentiators for Koppers versus others in the space.
So there's on the residential side, yes, innovation is definitely a differentiator for us. So we have a patented product, MicroPro, that is the industry standard. You'd find it in just about any lumber wholesaler, big box retailer. You'll find our products. We have 140 patents and are developing the next generation technology for that space right there. And then we have the commoditized space too, which again is more on the industrial side, railroad cross ties, utility poles, and in those spaces, basically we differentiate ourselves in terms of quality and service. We had a great quality control program offering lower total cost of ownership to our customer base, and that really differentiates us in the marketplace.
What does the artificial intelligence powered demand mean for your industry?
Well, there's no question that is increasing utility spend on infrastructure, right? And so for us, who play a key part in that in terms of providing utility poles to build out that infrastructure, whether it be data centers, whether it be electrification, the whole broadband expansion, what we're doing is going to help support that. And for us, we've been really focused more east of the Mississippi, southwest, our southeast, northeast, and what we've been doing is trying to expand geographically through some key acquisitions, get better able to reach up into the Midwest, the Southwest, out west, and so that's where our focus has been.
I gotta be honest, I don't know how many people maybe drive by their local infrastructure projects, the electrical poles, and think very much about it until, God forbid, something happens.
Right.
There's a horrible storm, and then you really have to think about those things. In your 16 years experience with the company, is that kind of the point of contact for a lot of consumers and the American people?
There's no question, and that's again another area where I think we stand out. We have our own trucking unit who basically storm response is a huge differentiator for us. We're out there responding to all those storms, making sure that the folks in the local communities can get the power back on.
What are the main headwinds, or I should say, let's say the tailwinds? What are the big beneficiaries out of Washington, D.C.? I'm thinking about the big bipartisan infrastructure bill Congress finally got over the finish line a few years ago. What do things like that mean?
There's no question that helps us. I mean, we're serving infrastructure markets, so anything that goes into that space is going to have a positive impact for us. And again, on the utility space with all the build out in infrastructure, another big tailwind. Yeah.
The stock performance is really interesting, up 40% already here in 2026, but you had this incredible stretch in February, I noticed. 11 green candlesticks in a row. Has something happened materially in the market since the start of this year? And something appears to have happened, at least in the month of February, I thought was interesting.
Yeah, certainly it was a big month for us, a big comeback month for us. I mean, it's been a pretty decent year for the materials markets overall. And, I think for us, we've been telling the story about the investments we've made through our last strategic planning cycle that has set us up for success here over the next 3 years. So our cash generation is going to be off the charts the next 3 years. Our earnings, we're expecting to see double-digit improvement over each of the next 3 years. So I think that part of that story is starting to resonate.
Ticker symbol KOP, up 0.8% on the day. Having a strong start here to 2026. CEO Leroy Ball, thanks for being here and making the case. Nice to have you.
Thank you.
All right, Money 2020 Scarlett Sieber is now back to explain the ways that fintech companies really make money. Take a look.
Welcome back. I'm Scarlett Sieber with Money 2020, and this is how fintech companies actually make money. The show where we decode how the coolest companies in finance turn millions of users into billions in revenue. Today, we're heading to LATAM to talk about Nubank, the purple giant that turned banking into a lifestyle brand. If you don't know, which I'm sure you probably do, but Nubank is one of the world's largest digital banks, offering cards, savings, credit, insurance, investments, and now crypto rewards. So how does Nubank actually make that money? First, credit revenue. Interest from personal loans, revolving lines, and installment plans. Second, interchange income from its massive card footprint. Third, deposit spread from its savings and investment products. Fourth, transaction and FX fees within its payments network. And now fifth, crypto-related revenue tied to spreads and engagement. So let's do that momentum check for a second. Nubank just launched a crypto rewards tool in Brazil, deepening customer engagement across its digital ecosystem. When we think about the moat here, what does the moat look like for Nubank? A brand love plus scale. Nubank's user engagement is unmatched, and layering new financial products becomes pure operating leverage. That is how Nubank actually makes money, by giving 100 million plus people the financial upgrade they deserved and monetizing every product that they fall in love with. And with that, back over to you.
Let's do it. Welcome back to the show. And on this Monday, this holiday shortened week, 1.3 billion shares in total on the closing auction here at the New York Stock Exchange, still resulting in a bit of downward pressure for several of the major market indexes. The S&P 500 on this Monday down in negative territory, 0.4%. The Dow eking out a small fractional gain off the strength of Goldman Sachs. The New York Stock Exchange Composite Index will sell off about 0.25%, and the small caps will finish in the red about 1.5%. Tomorrow on Wall Street, after the close, we get earnings from Nike, Beyond Meat, and RH, also known as Restoration Hardware. We'll get the latest data from the Case-Shiller Home Price Index crossing the wires in the 10 a.m. hour, JOLTS data for the labor market at 10 a.m., and a whole host of Fed speakers in the afternoon. That's going to do it for today's edition of Taking Stock. Thanks for watching. We'll see you tomorrow.